Welcome to the Teaminvest Wealth Builders podcast, where we bring you insights, strategies, and stories to help you build and compound your wealth and knowledge. I'm Kerry Fleming, your host for this exciting series. Whether you're a seasoned investor or just starting your wealth building journey, this podcast is designed to inspire, educate, and empower you. Let's get started. Joining me today are Tip Group CEO Andrew Coleman and Head of Funds Management and Education Sanjee Narendran. In today's episode, we're diving into one of the most debated and often misunderstood aspects of investing: how to value a company or an asset. You'll hear a candid conversation that cuts through the noise of traditional valuation models, exploring why so many common approaches fail to deliver real insight and how the Teaminvest methodology offers a more practical, reliable path for investors. We'll break down the pitfalls of market sentiment-based valuations, challenge the assumptions behind complex financial models, and share some straightforward, actionable principles that can help you make smarter investment decisions. Whether you're a seasoned investor, a business leader, or just curious about how to assess value in today's market, this episode is packed with insights you won't want to miss.
So we've been talking about trying to identify what's the right valuation on a company. And I know in my career in broking, I've been taught so many different valuation methods, but most of them, they just don't sit right. And when I came in, I started speaking to yourself and Howard and John, and the way you apply a valuation to a company resonated so much more with me. And I think that'd be valuable to discuss and expand on. So let's talk about some of the different valuation methods. What do you think the most common mistake people make when valuing businesses are?
Yeah, absolutely. Great question, Sanjee. So I think the problem tends to become because valuation methodologies fall into two buckets and they have quite large problems associated with each of them in general. The first bucket, of course, is the sort of market sentiment style of valuation. This idea of ascribing a multiple of earnings or ascribing a cap rate to a building or working out $1 per meter in a residential home. In other words, you're not trying to identify whether the asset itself has any value. What you're trying to guess is how the market is likely to perceive that in a transaction. So what a willing buyer and seller will offer you today for that asset. And that can work in really deep markets. So things like real estate, that tends to be not too far off getting a reasonable approximation of value, because you tend to be able to have lots of people that come in through an open house or a showing or a rental showing, and aggregating some form of valuation in between that, a market valuation. The problem, of course, with that comes for assets that are not traded all the time, or assets that have traded all the time but have a lot of uncertainty to it. So what do I mean by that? Well, the first thing is, any form of private asset that doesn't trade often, it's very hard to understand what the market sentiment is going to be to that asset if it only comes up once a decade for sale.
Yeah.
So that's an obvious first pitfall. The second problem is that, in effect, you're not actually getting any form of understanding of what the asset itself is worth. You're just getting a proxy for market sentiment. So real estate's a great example for that, but I mean, the stock market's an even better one, where I know you've spent your career. There is no rational reason why a company would change in value by 30 or 40% over the course of a year, and yet market PEs for the average company will move somewhere between 30 and 40% over the course of a year. Now that, of course, shows a clear logical inconsistency in that kind of methodology. The second kind of methodology forms really under what I would call fundamental or intrinsic value analysis. And that's really trying to say, well, look, ignore for a second what the market will perceive this to be worth and say, what is the underlying asset's value? What it's perhaps, if it's a building, is its replacement value? How much would it cost to build this thing again? In the case of a bond, what is the face value and what's the likelihood of repayment? Am I going to get my money back at the end, and how much money am I going to get? And then the third one, of course, which we'd be very familiar with in financial services, in valuing companies, is, what is the value of the cash flow that company is going to give you over time? Because in theory, the value of a company to the owner, not the employees, but to the owner, is simply how many dollars in dividends will I receive over the course of the life of this asset if I could hold it forever? Or alternatively, how much would I receive in dividends along the way, and then ultimately a final sale price? The problem, of course, with that methodology is that it has two big obvious flaws. The first is, at no point in that have we taken into account what the market will value the asset at any point in time. We've just said the replacement value. And as we know, for example, in your own home, your home's replacement value is a very minor amount of the total cost. It excludes the land, it excludes where it is, what's the location, what's the demand. So the valuation can be materially wrong compared to what the market will offer. And in the case of a more detailed discounted financial analysis, working out the cash flows, taking them back to today's value using a net present value or a discount rate, to account for risk and inflation, there are so many assumptions that have to fall into that model that in the end, it becomes really a case of you can make the model say whatever you want it to. Because a tiny change in any of those assumptions, which are perfectly logical. I mean, I don't know about you, but what's the difference between a WACC of 11 and 11.2, right? That's something that we can't understand. But it will move the value of the asset materially when you do a very long series mathematical calculation. If you're valuing an asset over infinity or even 20 years, tiny changes in percentages in growth, discount rate, market size, ability of management to execute, they will have material changes in the calculation. So you can end up with, as we see in the stock market, the same company with the same information, with tiny tweaks in the model coming out with brokers valuing at 30 or 40% differently. Now, of course, that's insane. In the same way as understanding using the multiples analysis is insane because you haven't actually understood what's the value there. So I think the obvious question you're about to ask me, Nesk, is, okay, so you've just told me that most of what we get taught in financial services and economics in valuation is great in theory, but useless in practice. So what do we actually do?
Well, that's right.
That's a good question. So I think it really boils down to two questions that you need to ask yourself. The first is, what is the purpose of the valuation that you're trying to undertake? So, if you're valuing your home for sale tomorrow, doing an intrinsic valuation or trying to work out what the replacement value of the asset is probably a waste of time. What matters more is what is the market going to offer me tomorrow with this real estate agent in this location, right? So a multiples analysis, a very simple peer analysis, is probably more than good enough because the odds are you'll be within an acceptable range. And why overcook the equation?
Well, that's it. I mean, one thing is if you're going to get a valuation for the sale of the property, another one may be an insurance valuation, which is for a very different purpose.
Absolutely. And you want to understand them very differently, right? Like if you're selling your house tomorrow, you don't really care how much, if this thing burned down, would I actually have to spend. You care, what am I going to get tomorrow in this market with this interest rate and this agent, right? So firstly, understand your purpose. Don't try and shoehorn the wrong valuation methodology into the wrong purpose. But the second thing, and I think I could talk more here from financial analysis of listed companies, because I think for a majority of the people who are probably watching this or listening to this podcast, that's the one that matters most. It's take a step back and say, if the model that you're going to use to value this either relies upon you understanding a sentiment of the market, which is almost impossible to understand, or it relies upon you forecasting with great accuracy a long time in the future, the odds are there's no point using that methodology at all. Because your likelihood of getting it right is so low, you might as well be guessing, flipping a coin.
So you say that there's no point in using it, but I guess it also depends on what your position is. See, if you're the broker, of course you need to use that. There is a lot of benefit in using that when you're a broker, and especially when you've got to now act for a client or a company to raise money for them, and they don't have anything that's tangible. So you have to put a guess on top of a guess on top of a guess to create a valuation that you can go out to the market to sell.
And I think there's 2 points to that. It's one, you have to have a justifiable valuation so you don't get sued.
That's right.
So therefore a very complex model looks better because that's very well justified. That showed a lot of work went into it. You can't be accused of being negligent in your deal.
Of course, that's right.
And then secondly, if I can perhaps be even more cynical, having a valuation that swings wildly day to day gives you the opportunity to have lots of defense in the event where it doesn't end up going the way you said it would. Well, I mean, my range was 25% up and down here. I mean, these things.
Of course. And if you don't like the one valuation method, you just switch to another one.
Exactly right.
But if you're an investor,
absolutely,
which most of us, well, now we're on the investment side of the scale. Okay, now we're going to look at it differently, because if I'm going to put my money into a company, I want to make sure I'm valuing it at a fair rate for me.
Absolutely. And I think this is where really, and if I could take the great work of one of our founders, Dr. John Price, you can use a couple of really simplifying smart assumptions that are obvious when you hear them, but are often not obvious when you're first thinking about it. So the first one is to say, shrink the time horizon that you're valuing. Predictions are very hard, especially about the future, as the great Yogi Berra said. The further out you have to make a prediction, the more likely it's going to be wrong.
Yeah.
So try and bring the time horizon in. So say, for example, when you're valuing a company, don't say, I want to value this thing out to infinity. Too much can change.
Yeah.
Try and say, I want to value it out, say, 5 years from now, somewhere where there's a horizon that you can see and you can visualize and you can understand what
That's right. It's got to be practical.
Absolutely. And probably in your investing sort of raison d'etre, 5 to 10 years is about the level you want to be looking at anyway. I mean, odds are, no matter how much we love a company, its management is going to change at some point. And so while we would like to hold it forever, the odds are we're going to hold it for somewhere between 5 and 10 years anyway. So it's a reasonable time horizon. The second thing to ask yourself is, what other simplifying assumptions can you make? And there are 2 really beautiful ones that John identified that we use a lot. The first comes out of some work from Drucker and Dreiman in the 1980s, and they were 2 US academics. And what they showed was that when it came to forecasting, US analysts, stock analysts, brokers, were materially wrong about their predictions 1 quarter ahead more than 80% of the time. So in other words, when they were asked to forecast what was going to happen to earnings up, down, sideways, 1 quarter ahead, 3 months ahead, they got it wrong 8 out of 10 times.
Yeah, that doesn't surprise me. I've seen analysts put out forecasts and put the opposite forecast within a week of each other.
Absolutely. So John, being an incredibly smart academic, turned around and said, that's ridiculous, right? Like, your chances of flipping a coin are better than that. How is it that they're getting it so wrong? And so he did the question that we so often don't do when we're looking at data, which is try to understand what was going into that data. And he broke the sample set into 2 groups in the sample. The first were those companies that he determined using a proprietary metric that we use today called STAGO, which stands for Stability of Earnings Growth, were stable companies, and those that were unstable. In other words, the company itself had something that made it inherently unforecastable. Its earnings were up, down, sideways, management was changing, it was in an industry in flux. And it turns out that when you looked at the companies that were inherently unstable, no surprise, the analysts were almost always wrong.
Yeah.
And that's not really a reflection on the analysts. That's asking someone to predict something completely random. The odds are you're going to be wrong.
Yeah, I mean, it makes sense, right?
Absolutely. But when you look at the sample of companies that were stable, it turns out the analysts were right about 70% of the time. Now, that's still not perfect, but that's a hell of a lot better than being wrong 80% of the time.
Well, it makes sense, because if you're an analyst and you've got a stable business and you're asked to make a prediction on something that's stable, you can actually look at the business itself and say, okay, this is how the business is been producing. I can make a guess at that. But if you're asking someone with something that's up, down, and sideways, that can be influenced by the market sentiment in, the economic, macroeconomic, microeconomic, global situations that are all going to impact the price of this, then you really want to then you're guessing on a guess.
Absolutely. And the key there is that earning stability, right? So taking out market sentiment and just saying, is the profits of this business stable? And it turns out if the profits of the business are relatively stable over time, you can make a good prediction about what the profits are going to be in future. Yeah. So all valuation methods, as we've just talked about, rely upon something, some underlying item, whether it's square feet or dollars of earnings or dividends. If you can get one of those items, in this case, we're talking earnings, but if it was property, it's square feet or whatever, or square meters. If you can know that, so you have one piece of knowledge, then you only have to solve one other part of the equation, which is how is the market of willing buyers and sellers in the case of property, or the market as in the ASX or the NASDAQ in the case of stocks, going to perceive those earnings some period in the future.
Yeah.
So if you can say with great reasonableness that your stability is high on earnings, then you only have to ask what's the question of how markets will perceive that. And there's a really, really simple shortcut. It turns out that the long run market average across individual companies and industries for about 120 years has been in the range of 15 to 25 times earnings. So if you just take a proxy in the middle, call it, say, 20 times, adjust it a little bit up and down from 20 if you really like the company, 25, really down if it's boring, 15, and you apply that to a number you have great certainty on, your accuracy of your prediction is going to go through the roof. So what does that really mean for an investor out there in the market? If you have the luxury of choosing to only value companies that are stable, you can pick almost any valuation methodology you want and you'll get pretty close. That's what that analysis basically tells you.
Easy.
If, on the other hand, you're having to pick companies that are inherently unstable, then it's almost impossible. So really, maybe what we should be doing when we're looking at valuation is not trying to work out what's the value of the asset as the first step, but really, is this a stable asset that can be valued at all?
That makes a big difference.
And that's the real secret sauce in valuation. And it's why our valuations tend to be much more accurate than our peers. It's not because we're better at doing it. We're just not wasting our time trying to value the inherently unvaluable.
That's right. Just focus on the companies that we can value and then come up with the best of those companies and say, well, that's all I need to park my money.
Exactly. So the challenge now, I think for everyone listening, certainly for you and I in our portfolios, is what we hold something stable enough that you can value it, or are you in the realms of instability and guessing? And I'll leave that to you.
Thanks, Andrew.
Thank you for joining us on this episode of Teaminvest Wealth Builders. We hope you found today's discussion insightful and inspiring. If you know anyone else who could benefit from hearing this episode, please hit the share button and pass it on. If you'd like to learn more about Teaminvest or our unique investment approach, visit us at teaminvest.com.au. And please don't forget to subscribe to the podcast for more episodes. Until next time, stay informed, stay invested, and keep building wealth.